In just 48 hours, $2.5 billion in leveraged crypto positions were liquidated. Bitcoin crashed through $65,000, a level it hasn't seen since last October. One single trader on HTX lost $61 million in a matter of minutes. But here's what nobody is talking about. This crash wasn't caused by crypto. It was caused by a $200 billion credit fund you've never heard of. And by the time you understand why, you'll see this market completely differently. Let me set the stage. On one side, you have Trump announcing fresh 15% tariffs on global imports. Markets shudder. On the other, you have Blue Owl Capital, one of the largest private credit managers in the world, suddenly halting redemptions. Think of it like a bank quietly locking its doors while telling everyone everything's fine. Bloomberg, CNBC, Reuters, they're all covering the Bitcoin price, but almost nobody is connecting these two seemingly unrelated events. And that connection, it changes everything about where crypto goes next. Now the obvious take is simple. Trump tariffs create uncertainty. Uncertainty kills risk assets, crypto drops. That's what every headline says. And it's not wrong, it's just incomplete. It's like saying the bridge collapsed because it was raining. Sure, rain didn't help. But the real question is, who built the foundation and what was already cracking beneath the surface? So what's really going on? Here's angle one that nobody is discussing. Blue Owl Capital manages over $200 billion in private credit, loans to companies that can't get money from traditional banks. When they halted redemptions, it sent a shockwave through a hidden layer of finance that most crypto traders don't even know exists. Here's the connection. Many institutional crypto investors, the ones who poured billions into Bitcoin ETFs over the past year, are the exact same funds that have exposure to private credit. When Blue Owl locked withdrawals, these funds suddenly needed liquidity. And where do you go when you need cash fast? You sell your most liquid asset. This explains something that puzzled analysts. Bitcoin ETFs have seen $3.8 billion in net outflows over the past 5 weeks, the longest streak since their launch. BlackRock alone signaled a $270 million sell-off across Bitcoin and Ethereum positions. This wasn't retail panic. This was institutional plumbing breaking. The irony? Bitcoin was invented to be independent from traditional finance. But the more institutions adopted it, the more it became a pressure valve for exactly the kind of crisis it was designed to escape. Mind blown, but that's only half the story. Here's angle two. While everyone panics about the crash, something extraordinary is happening at the SEC. In the same week, Bitcoin lost 15% of its value. The SEC quietly proposed reducing capital charges for stablecoin holdings from 100% to just 2%. That's not a policy tweak, that's a revolution. They're essentially saying stablecoins deserve the same treatment as Treasury bills, and they proposed treating Bitcoin and Ethereum as assets equivalent to gold for capital reserve purposes. Think about the timing. The SEC doesn't make moves like this by accident. While the market is bleeding, regulators are building the infrastructure for the next leg up. It's like watching construction crews pour a new highway foundation while everyone is stuck in traffic from a crash on the old road. The people in traffic only see chaos. The construction crew sees what's coming next. Robinhood's data confirms this split reality. While prices crashed, their trading volume surged. But here's the fascinating detail. Investors weren't just buying Bitcoin and Ethereum. They were diversifying into altcoins at the highest rate this cycle. The smart money isn't running, it's repositioning. So how does this affect you? If you have crypto, the Blue Owl contagion means more institutional selling pressure could come in waves, not from people who don't believe in crypto, but from people who need cash for entirely unrelated reasons. Your Bitcoin might drop not because of anything Bitcoin did, but because a private credit fund in Connecticut had a bad month. That's the new reality of institutional crypto. But simultaneously, the SEC framework means that within 12-18 months, holding stablecoins and Bitcoin could be as capital efficient as holding government bonds. Every bank, pension fund, and insurance company will need to reconsider their allocation. The demand pipeline being built right now dwarfs anything we've seen. Here's my prediction. This crash takes Bitcoin to the $58, $000, $62, $000 range before the Blue Owl contagion fully plays out, potentially within the next 2-3 weeks. But the SEC regulatory shift creates a structural floor that didn't exist before. By Q3 2026, we could see Bitcoin testing new highs, not because of hype, because of accounting rules. The biggest question nobody is asking: if the SEC treats crypto like gold, what happens to actual gold? Drop a comment with your take.